Good afternoon, everybody, and welcome to the show. Today, thank you for taking the time to invest in coming to learn about how the three big taxes impact your portfolio, namely the Landlord Tax, or better known as Section 24, Inheritance Tax, and Capital Gains Tax. We're going to explore in the next 35 or so minutes those three subjects and how it affects your portfolio. So wherever you are today, sit back and enjoy, and at the end we'll do questions and answers with the entire team. So in 2015, we started to see legislation changes that started to fundamentally impact landlords' portfolios and impact your business. The first of that was Section 24, now known as the dreaded Landlord Tax. This is where mortgage interest can no longer be used as a cost against your rental income, meaning for those of you who were or are 40% taxpayers or are having to move into that because of this change, you're now paying tax on your mortgage payments, which is incredible. But there you go. That's where we are today, and there are things you can do about it, and we'll talk about those as we go through the presentation. One of the consequences of that legislation, apart from increasing tax and putting the pressure on landlords to have better advice and probably to upgrade their advisors, was we've actually seen 3,800 rental properties a week coming onto the market as the amateur landlords are bailing out. There were something like 1.75 million landlords here in the UK when that legislation first came out. And we think there are somewhere between 200 and 240,000 professional landlords like you and me who actually are in this for the long term, see this as a business and see this as something that's here to stay and to be put in place for our future generations and for our pension and for lots of other reasons. All good. And then this third thing that we've seen come through is the stamp duty changes that came out in 2020, which currently has created this property bubble. And all the landlords I'm talking back are stepping back as prices go up, waiting for what we think, and according to the FT says, up to a 20% drop in prices as the stamp duty ends in March of next year. And then I read at the weekend, the government's got a white paper out now looking at the energy ratings of rental properties. And if you're not C or above, they're talking about allowing councils to fine us £30,000, which I think is incredible. So clearly there's lots to do here. My objective today is to give you solutions, is to educate you, to solve problems so that you can get on with doing what you're best at, doing deals and building your property portfolio. So as the National Landlord Show has moved now to online, we want to make sure that you get the most out of today. We're offering a free consultation. In order to take that free consultation up, you will have to write to us at the email address below, property@acuityprofessional.com. Simply ask for a free consultation and we will immediately respond with an email and a link that allows you to click on the link that will take you to our diaries, and you can choose the date and the time that you want to have a consultation with us, and we'll spend some time with you figuring out where you're at, where you want to go, and how we can best help you. So I wear two hats. Firstly, I'm a landlord with our family. We've built up a portfolio of 45 properties over the years in our buy-to-let portfolio. Most of them just straightforward buy-to-lets, a couple of HMOs up in Southport. And like you, we've suffered the same legislation changes through, and we've put plans and structures in place to negate that so we can get on with what we're doing, which is running a property business. I've had a double murder, and I remember my brother-in-law, I remember the phone call to this day. It was almost a brand new property we bought, and a double murder happened. And it turned out that he thought that the police go in and clear up after those messes. And that is not the case. I think he'd watched the film Samuel Jackson, The Caretaker. The truth is that Rentokil have a dedicated department to come and do that. So should that ever happen to you, and I wish it doesn't, but you know, we're involved in many lives here, as we are as landlords. Then the other thing that we've had is I've paid for a guy who lost his job to retrain as a driving instructor. He's been in that property very many years. He's paid us back every single penny. We paid for a child who sadly died in one of our properties. Again, the parents paid us back over time. We have very little churn in our portfolio, and we have a great business, and I absolutely love property. The second hat I wear is that I'm a senior partner in a corporate planning team where we provide services to landlords and businesses as part of Acuity Professional, and we provide tax advice and tax planning and lots of other solutions, and that's the team that you're dealing with here today. So since 2015, we've helped over 3,000 landlords look at all sorts of issues in their business. Our team have helped them by looking at their numbers, looking at their ambitions and their goals, often during the consultations that we offer for free, and then coming up with options and solutions for them. Now, there's something quite interesting here is when I get hold of most landlords, they rely heavily on their accountant for advice, and that's great. Your accountant is your trusted advisor. We have loads of them in our business. We have a 300 head count. You know, I totally understand that thinking. However, most landlords tend to go for one-man, two-man band practices. And the problem with that is that accountants tend to be generalists. And I just want to pop this myth. And they're like doctors. Doctors are generalists. And if you and I had a major medical condition and I walked up the road to my GP practice with a brain tumour and went and saw my doctor, Dr. Harry, and he said, "Oh, Simon, come in the back, lie on the table, we're just going to inject you now and I'll whip that tumour out in seconds," I would have a hissy fit, as you probably would do, because you don't expect a generalist to deal with a specialist topic like that. You expect to go see a specialist surgeon. It's the same when you get technical tax issues, legislation changes. Your generalist accountant sometimes misses it, doesn't get it, and needs to refer you to a specialist. Or you need to come to a bigger firm that has specialist divisions like Acuity. We have divisions for wills and trusts, for estate planning. We have divisions for providing you with investment advice and pension advice. We have a mortgage desk. The list goes on, but you see what I mean. Bigger practices have specialist teams that can pick up on not just legislation changes, but other things that are important to running a business in this modern day. Now, every landlord's situation is unique. There is no silver bullet out there today. I can never guess which way a landlord's going to go when we do our consultations, and for those that believe there is a silver bullet, it does not exist. However, I think there are two key concepts for people to grasp, and that is that when you spend time with us, we'll often look at putting companies in place and structures in place, because different company structures have different legislation, and all that really does is allow you to use two sets of legislation that often allows you to find a better way of doing things. And I think that's quite key, doing it in a better way within the legislation, within the law, that solves problems and allows you to move forward and get on with doing the business. The thing I love about tax planning is it creates certainty. A bit like, you know, when I said earlier, you take out an ISA, which is a tax-free wrapper, you put your 10 grand in, your 10 grand grows to 15, and you don't pay capital gains tax on the 15,000. That is a known certainty right at the beginning when you put tax planning in place. And this is the whole process that we're looking at here. So I think that, you know, there's the old saying, it's not that you plan to fail, it's just that you fail to plan. So come and spend some time with us. Allow us to look at your numbers, look at your goals, look at the problems you're facing, look at your ambitions, look at where you want to go to, and help you plot a course with us to achieve that end goal. I think the three biggest things in terms of the world of tax that landlords need to spend some time thinking about and considering are Section 24, the landlord tax, inheritance tax, and I think that's the big sleeping giant in the background. And then for some of you, not all of you, because most of us are on a buy and hold strategy with our portfolio, but some of you will want to sell your portfolio because the numbers don't work, or licensing restrictions have become too difficult, or you actually just want to sell it all, take the money and spend the rest of your days spending it and going around the world. And if that's you, I don't blame you. But of course, capital gains tax sits in the background, and people come to us going, I've got this, what is the best way forward? What are the things I need to consider, and how do I go about it? So if any of those three impact you, and of course one of them certainly will, then you need to spend some time with us. And I think that when we look at things like this coming up, we spend a lot of time with our technical tax team, with lawyers, with accountants, with wills and trust teams, our insurance teams, looking at building things that allow people to solve problems. If you are a landlord today and you have 4 or 5 properties, you have over £600,000 worth of lending, you're either on the marginal 40% tax, or you're in the 40% or even higher at 45%, you need to come and have a consultation with us. So we have multiple ways of approaching the landlord tax. Different solutions are right for different people. We're going to show you now the most popular solution that we put in place, called the mixed partnership. We've been using this since 2013. I'd say it's our go-to, it's our favourite solution by landlords for lots of reasons. We'll explain that on the consultation. But let's have a look at the video now that explains how the mixed property partnership works.
What is a mixed property partnership? Our mixed property partnership is a unique commercial offering which utilises an LLP to mitigate the impact of Section 24 without the costs of transferring your property portfolio to a limited company. How does it work? The approach involves you and a limited company, also owned by you, forming an LLP, thereby creating a mixed property partnership, an MPP. The properties move from you, the individuals, to sit under the MPP. Rents, maintenance costs and your drawings are also moved to the MPP. The mortgages move from you, the individual, to sit under and be the responsibility of the limited company. The MPP profits are split between you and your limited company. You remain the legal owner of all of your portfolio, and as such, AST's insurance and mortgages can remain in your name. What are the benefits of a mixed property partnership? Section 24 no longer applies to your portfolio because all mortgages will be the responsibility of the limited company. Any profits that go to the limited company will be taxed at 19% rather than the typical 40% for individuals. You avoid the fees and charges associated with incorporation, such as legal fees and valuation fees. It doesn't trigger SDLT or CGT. It allows the future transfer of the properties to a limited company. You can add family members to the business without incurring CGT or SDLT. Adding family members to the business may reduce inheritance tax. And finally, company car tax does not apply to LLPs, so you may be able to apportion a section of your car costs to the LLP, which may save you tax.
So the first one we're going to look at is the landlord tax. As you know, the legislation impacted in 2015 and started to make a direct impact on our portfolios and how we recorded our numbers for tax in 2017, and in the current year at its maximum level, where all of the mortgage interest cannot be used against your rental income, and then in the tax return they give you a 20% credit back. So it's an expensive time if you haven't got a handle on this, and if you've not yet sat down with a team of professionals and looked at how this is impacting you, and they've actually worked out the numbers and the consequences based on your current earnings and your earnings from your portfolio between you and your partner, or you and your business partner, you and your kids, however you've set your business up, then you need to come and spend time with us. There are lots of ways forward for people that are facing this, that are sensible and are commercial and are the right things to do, and we'll talk about those when we come and see you. They're affordable. All of our fee plans come with a 0% 12-month instalment payment plan, if that's where we get to with you. So they're very affordable. All of our landlords really appreciate that. They appreciate the service that we give, they appreciate the advice we give, and they appreciate that we're a large firm. We're not a one-man band. We're not a team that have just set up to make money from landlords. You know, we've been around for a long time and will continue to be around for a long time, being a large accountancy practice. And we've got lots of people here with different skills to spend time with you and help you through and work out what is the best way forward for you as a landlord. So why don't we now delve into the Business Succession Trust, our trust planning for inheritance tax. Again, we've done another video that explains how it works. So let's just take a minute and have a look at the video now.
How could a business succession trust, a BST, help you? As a landlord, your property rental business does not qualify for business property relief, which means that your estate will be liable to pay 40% inheritance tax on the value of the business. This could result in it being difficult to pass the business on to the next generation in its current form, as properties in the portfolio may need to be sold to pay the inheritance tax costs. How does a BST work? A BST is made up of your company, shareholders, trustees. The company will be required to appoint a trustee who will help the company to administer the trust and distribute capital or income to the beneficiaries subject to normal taxation. It is important to note that beneficiaries cannot just take funds from the trust as and when they want, and the trustees will always be guided by your company. Potential beneficiaries. The BST is a discretionary trust, which means that past, present and future employees of the company, as well as their families, are potential beneficiaries of the trust. Protector. The person or entity that has the power to remove and appoint trustees, normally the company itself or a director. Once the BST is set up, the company's shareholders can gift the majority of their shares to the BST, anywhere between 51% and 100%. From a tax perspective, the BST benefits from a number of favourable statutory reliefs, which means that there is no capital gains tax triggered by any shares gifted to the BST. The value of any shares gifted to the BST is immediately outside of your estate for inheritance tax purposes. The gifted shares are not subject to the normal 7-year waiting period. The BST is not subject to 10-yearly inheritance tax charges. What impact will a BST have on running your company? As directors, there will be no change to how you manage the day-to-day activities of the company. The BST will hold the majority of the shares, and as none of the properties will be transferred to the BST, this means tenancies and finance can remain unchanged. In terms of income, you can continue to take dividend income, provided you keep some shares outside of the trust, or alternatively, you could take a salary and bonus, and we can advise you on this. Is a BST accepted by Hmrc? Yes, a BST is a well-established form of a UK discretionary trust, which has been used extensively by UK companies for many years. Am I eligible for a BST? To qualify for the tax benefits of a BST, you need to have a genuine property rental business with genuine employees. We can help you to work out if you are eligible and guide you through the process. Is gifting shares to your children during their lifetime an alternative solution to a BST? Yes, but gifting shares has some major drawbacks. 1. You will often have to pay a large capital gains tax bill on gifts. 2. The gifted shares take 7 years to be exempt from inheritance tax. 3. If you gift shares to children, these gifts are not protected from their potential divorce or if they run into financial difficulties. 4. You need to consider if you are ready to make such a large gift, as it will result in the loss of control and access to your dividend income. We can advise you on all aspects of setting up your BST and guide you through the process. We look forward to helping you.
So here's an interesting fact. The average life here in the UK today is around 4,000 weeks, and as soon as I say that, normally I can see a room full of people all trying to work out where they are in that 4,000 weeks. There are only two things that are certain, and that is death and taxes. And whilst we have no cure for death today, we certainly do have ways forward for how you handle taxes and how you provide for those certain situations. Now, some people die leaving inheritance tax bills to pay, and if you're a landlord and you've got equity in your portfolio, that can be a fairly hefty tax bill to pay, which often, when the children and dependents and wives and so on are dealing with that crisis of death, then to be faced with having to pay the tax bill and sell assets, of course, just adds to that whole trauma. And I'm sure that all of us are doing this for long term. We want to leave a legacy for our children and for our grandchildren. And we'll talk about that, how you can do that and how you can do that correctly.
So my name's Phil Bryant. I'm the head of the wealth team at Acuity Professional, and I'm also the head of the estate planning team at Acuity Professional. And we work predominantly with landlords, and we look at pulling our connected service together. So we've got some fantastic tax planning products and tax planning structures that Simon is responsible for, and I normally come in to speak to the client with regards to their estate planning, because once the structures are in place, the need and requirement for estate planning is a lot more important because it's representing different entities. And alongside that estate planning, ensuring that the assets are directed into a trust, which is obviously the best and most optimum way of dealing with estate planning, we're also able to source life cover potentially paid for via the limited company, which is again potential saving of up to 50% for the clients because it's much more tax efficient.
So I mentioned a lot today the incorporation process, and if you're looking at a capital gains tax challenge, that is certainly one of the obvious ways forward. So let's just go look at the benefits of incorporation. And to that end, what we've done is, again, we've provided a little video here to explain what is incorporation and what are the benefits. Let's just take a look now.
What are the benefits of moving your property portfolio into a limited company? You only need to pay 19% corporation tax on rental profits and capital gains, rather than the typical 40% rate for individuals. Section 24 does not apply. You get limited liability protection, which should mean that you are not personally responsible for the debts and any financial losses of the limited company. It provides a platform for inheritance planning. You can access mortgages at a higher loan-to-value ratio. So why haven't all landlords transferred their property portfolios into a limited company? If you transfer your property portfolio into a limited company, you will normally have to pay capital gains tax, CGT, and stamp duty land tax, SDLT, but there is a way around this. If your property portfolio operates as a business and sits in a partnership or an LLP, then you should be able to transfer your property portfolio into a limited company without CGT and SDLT. How can we do this? The property business, including the property portfolio and mortgages, are transferred to the limited company in exchange for shares. This means you don't have to pay CGT until the shares in the company are sold, and you don't have to pay SDLT. How can we help you through this process? We structure the business transfer to fall within the rules for CGT relief and the special SDLT treatment. We liaise with your legal representatives to ensure that the SDLT returns and property transfer documents are structured appropriately. We review the relevant financial statements and tax returns to ensure that the filings adequately reflect the transactions.
Whilst most of us are on a buy and hold strategy and not looking to sell, there will be some landlords here today listening to this presentation going, actually, I do have properties that I want to sell, either because they no longer work, the numbers no longer work, or they'd rather get the money out that's locked into it into different properties or different projects. The problem is that when you come and sell most of these properties is that they are subject to something called capital gains tax at 28%. That's where you bought a property for 100,000, it's now worth 200,000 pounds, and you have a 100,000 pound gain, i.e. it's grown 100,000 pounds above your original purchase price. And after we deduct any capital losses that you may have had that are involved with that property, you're left with a 28% tax bill on whatever that gain is. Now, there are ways to address this, and we certainly would like to spend time with you. I think there's a second group of people, and that is people that are looking at incorporating, that really want to move their portfolio to a limited company for succession reasons, for limited liability, protection reasons, so they don't get sued, they can be protected, and I understand that. And if that's you, then that's great. But one of the things we have to check in your numbers is that, something called latent gain. And latent gain is where you bought a property for 100,000, and let's say it's now grown to 500,000 pounds, and you've increased the mortgage over time. So the mortgage now on 100,000 original purchase price is at 400,000. So if I take the 100,000 pound original purchase price and deduct it from the 400,000 pound mortgage you have today, that's a 300,000 pound difference, i.e. the mortgage is 300,000 pounds higher than the original purchase price. If we come to incorporate that, I have an issue to deal with on the 300,000 is that there's a tax charge on that on you directly, because it's seen as you've had income out and it doesn't actually enjoy the reliefs on incorporation that other people do around capital gains tax and stamp duty. We're here for you today, tomorrow, we're here for your children, for the next generation. We're a firm that's going to be around for a long, long time. So we want to take you on that journey. And if it's accountancy practice you're looking to just upgrade your accountants, You know, we've got over 300 of them. We've got one particular team that are dedicated at dealing with specifically landlords, headed up by Debbie Hargreaves, our managing partner. Her typical landlord goes from 1 property to 200, with 50 being the sweet spot, with developments either side. She's got a vast amount of experience in her team, advising landlords on their portfolios and what they can do and how best to treat things, and she's highly valued by all our landlord clients. So,
hi, I'm Debbie Hargreaves. I'm the managing partner of the Sussex office, and I manage the team as well as a portfolio of clients. Clients generally come to us for property accounts advice and assistance due to our experience with landlords and property developers over the years, which has spanned from one-man band clients that own 1 or 2 rental properties to those that own a portfolio of 50, possibly 100 rental properties under different structures. We then advise them on how best structure the portfolio and work on tax efficiencies throughout the year to ensure they're as compliant and as efficient as possible. We encourage all of our clients to be speaking to us at least once a year. We generally want them to be talking to us throughout the year so that we can help them plan for the year ahead and get things right, rather than retrospectively reorganise the work they've completed. Generally, just after the tax year end is a good time to find out what's been going on in the previous year and also your plans for the year ahead. Obviously, we do see a lot of clients throughout the winter months of the year. Generally, we encourage you to come in the summer months just to plan properly for the next year before we're not dealing with historical information.
So this is the time in the presentation normally when we're doing a live event where we would do Q&As from stage. You'd come and ask your questions, or you'd come and see me by the side of the stage afterwards. But of course today we can't do that. So my team are going to be providing Q&A sessions at the end of this seminar. So ask your questions if you haven't done so already, and we'll do our best to answer them. Either way, it's been great spending some time with you. Thank you for your time. I hope you've got some value from this. I really look forward to meeting you on the consultations, and we'll take good care of you when we see you then. So thank you for your time. It's been great spending time with you today. Thank you.